Hello, I hope this finds you well. Today is Friday, February 19th, 2016, and in about 5 minutes I will share with you a brief overview of the markets last month, shed some light on the recent market volatility we have experienced, and answer the all-important question, are we in a recession? So let's get right into it. As you already know, 2015 was a lousy year in terms of returns, and 2016 has not been any better. If anything, it's been worse, unfortunately. The S&P 500 finished January down 5% on the month after rallying at the end. At the worst point, the S&P was down 9%. Some investors are concerned and have been focusing on this saying, as goes January, so goes the year, with the thought process being that if we have a positive month in terms of returns in January, we'll have a good rest of the year in the market. And conversely, if we have a negative month of returns in January, then we'll have a bad year in terms of returns in the markets. And I'm here to share with you that this indicator or this saying, while very catchy, is not accurate for the most part, and certainly has not been accurate over the last 4 negative Januaries. So please keep that in mind. So why are stocks pulling back so much right now? There are 4 main concerns the market has been focused on: China and oil, which are very much themes we've been talking about for a long time, certainly all throughout 2015, and the US economy and the question of are we in recession or near recession, and lastly, corporate earnings. There are certainly plenty things I could share with you on all 4 of these themes, but in the essence of time, I'd like to focus on the US economy today and answer the question, are we in recession? There has certainly been lots of recession talk recently in the media. LPL Research has put together 5 recession forecasters, which are 5 indicators that collectively have historically signaled the increasing weakening of the US economy and transition into an oncoming recession. So I'd like to share with you those updated indicators now. As you can see, currently these indicators are generally sending mid-cycle signals. 3 of the 5 indicators are flashing warning signs: market breadth, ISM PMI, and market valuations, while 2 are still in the green, collectively signaling that this bull market may continue and that the latest S&P 500 correction may stop short of a 20% decline, which would officially end this bull market, and push us into bear market territory. While the S&P 500 is currently pricing in a 50% probability of recession, we still believe that recession in the next 12 months is unlikely, and we are definitely not in one now. Although there is much negative sentiment to talk about, many negative things we could focus on, there are still a few bright spots to keep in mind that I'd like to remind you of today. The consumer sector of the economy remains solid and should continue to benefit from low gas prices. The labor market is still strong, and interest rates remain low. I've said this before, but I think it's worth repeating. Investing is a marathon and not a sprint. So we have to be very careful not to let ourselves get caught up in the negative emotional cycle that is short-term stock market pullbacks. We need to make rational, clear, well-educated investing decisions. Thank you for taking the time to watch this. And if you have any questions, as always, please feel free to give me a call. Take care.